What I'm going to do here is just click play. This is an example from this week on the E-mini S&P where the market was moving lower. Now, from understanding what you understand of the market hitting the bids and lifting the offers, and you're looking for aggressive behavior. So you're asking yourself, okay, is the market, this is the question you've got to ask yourself when you're reading the DOM and you're reading order flow. Okay, is the market taking out the bids and moving sequentially lower, or is it taking out the offers and moving sequentially higher? Right, on the right hand side of the DOM, you'll also see a time and sales window. Now that will actually show you what orders are coming in and hitting into the bid and actually trading, and what orders are actually coming in and lifting the offer and actually trading. So the volume on the trading ladder that I highlighted earlier, the pre-trade demand and supply on your DOM, are limit orders waiting to get filled. The actual trade that we're interested in is what you see on the right hand side where it says price and quantity. Okay, the actual volume that is traded is shown by quantity. That's the time and sales. Okay, so what you're watching out for here is at 45 quarter we see 366 on the bid, and then on the offer we see 723. Okay, let's just move back. Hold on. Just going to pause this. Okay, so we're back to 45 quarter. We've got 462 on the bid now. We've got 1345 half with 772 on the offer. Now, this sequence is when the market was in a downwards move. I think it was on Wednesday. And the market takes out the bids all the way down to 43s. And then the 43 bids start to hold, and the sellers can't take out those bids. And then what starts to happen is that you'll slowly start seeing 43 quarter being lifted, 43 half, and then it starts to come back towards 45. So it's like a 2-point rotation down and a 2-point rotation up for the E-mini S&P. So watch it as it starts to trade, and I'll pause it every now and again. So notice as we're trading, you'll see the time of sale showing some of the big orders. I usually highlight 10 lots or more, and they will be highlighted in blue and in red on the right hand side. So what's a 45 quarter? We're heading into the 45 quarter. We just started to pop below the 45 quarter. Then we take it out. Okay. So notice now we've got some volume sitting there on the bid. At 45s. Okay. 300 odd sitting on the bid there. Okay. Some volume sitting on the bids at 45s, and then some volume sitting at the offer at 72. At 45 quarter with 722 or somewhere along that line. It won't be exactly the same, so some of you guys might see a slightly different number there, but you get the idea. We're traded down from 45 quarter down to 45, and now you see a bit more selling coming in on the time and sales. So you'll see 15 lot there, 21 lot there, etc. So what I want you to do is just observe and just watch it as the market continues to trade into the bids. It will fluctuate up and down. It will trade between the bid and the ask. So sometimes it will move between the current bid price and the current asking price, which is 45 right now and then 45 quarter. But then slowly but surely it's moving lower. It's sequentially moving lower. So price is advertising lower and it's taking out the bids. So there's a bit of a selling imbalance. Sellers are taking out the bids and the supply is starting to exceed that demand. So keep watching and you'll see it. And when you're reading the DOM, that's what you want to ask yourself. Okay, so let's just pretend we've come off an area where we want to short. Okay, and we start to see this taking place from 45s. So we're watching 45s. There's a bit of rejection. I'm watching the bids and offers trading. But the most important thing here is that we're watching to see whether we can keep pulling away from where we've just stalled. So 45 quarter is the area where we've just found resistance. And so that needs to become your reference point. So 45 quarter is the area you've seen us find resistance now. And then as we continue to trade lower, notice that the sellers keep hitting into the bids and keep taking out the bids. The volume that's sitting there on the bid, on the inside bid, slowly and surely keeps getting taken out. Okay, and then we keep pushing lower. Now we might uptick every now and again. Okay, you can see we take out some bids and uptick a couple of ticks. That's okay, that's normal. But the main thing here you want to reference is the 45 quarter where this move started. Are we still moving away from 45 quarter, and is a selling imbalance still occurring? So 45 quarter is a reference point. Okay, we test that 45 quarter. There we are. Come back to it again. Okay, so the market will do this. It will trade lower, trade up, trade lower, trade up, trade up, lower, trade up. I've got a sequence later where I actually take a trade off this, and you'll see how it works in real time when you actually have a trade on. Okay, but this is just the dome itself, firstly. So look, are we still moving away from 45 quarter? Are we still hitting the bids at sequentially lower prices? Yes, right? That's the question you've got to ask yourself. Are we moving away from that area that I'm expecting some sellers, and are we hitting the bids at sequentially lower prices and continue to move away from it? That's the most important question. Yes, you are. Okay, don't get tied up on the amount of volume that's on the bid or the amount of volume that's on the offer. You're not interested in that. You're just looking at the sequence, and is the market moving away? Is it continuing to become imbalanced lower? And you keep watching it as it keeps hitting the bids, and then you see the sellers start getting a bit heavier again, hitting into the 43.75. Notice how it keeps coming back to 44 quarter, retests, pushes lower, comes back up again, retests, pushes lower, retests. Okay. Notice how we're taking out the 44s. We're testing the 44s now. 44s is acting as resistance. Buyers are trying to lift those offers, but the offers keep coming in. Okay, the offers keep coming in at 44s. And we keep taking out the bids. Okay, now we're at 43.5. So we started up at 45 quarter. Now we're down at 43.5. Then notice, now when we start to get lower, I'm just going to pause this, so some of you guys, I notice, are logging in and out, so maybe your videos are getting left behind or whatever. But now if you're watching the online version, which I've sent you the link to, it pretty much should be in line. It should be streaming pretty well. Well, it's not streaming, you're actually watching it online as and when I'm presenting it, so it's not streaming, so that should be pretty much real time. But any of you guys that are watching this through Instant Presenter, because it is being shared there as well, keep an eye on it, but just recognize you might be a little bit behind and a little bit delayed. Okay? We've lost some people there, but I'm not sure why that is, but it might be because they're having some internet connection issues. So let me just check that you guys that are still here, can you guys still see what's going on? Are you guys following me so far? Before I continue. Okay, good. Thanks. We lost some people, that's why I'm just double checking. Okay, so just notice this. What will happen in this situation? I can't remember exactly, but I think it gets to around 43. Notice the 43, it's got about 2,500 sitting there on the bid. Now watch that 43 as we hit into it and see what happens. Okay, hit into the 43, look what happens. The bids keep piling up at 43. Okay, and then all of a sudden there's some bids coming at 43 quarters. We're hitting into the bids, but now all of a sudden, you start watching, we'll start seeing some orders being lifted on the time of sales. You'll actually see about 100 lot being lifted there. Most of you guys should be able to see that at 43 quarter, which is just above the 43. Okay, 100 lot just came in, lifted in one go. Okay, now be aware though, however, bigger players, bigger traders don't always come in with big size in one go. You know, when I'm trading 40 contracts, I very rarely go in with 40 contracts. I will go in with 10, go in with another 10, then another 10, and then another 10. If I'm scaling in up to 20 contracts, I'm going to go in with a 5, a 5, and a 5. Okay. A lot of the time, if you go all in, you get partial fills, especially if you're looking for limit orders, even on liquid markets. Not a lot of you know, sometimes. Okay, so the way around that is to just whack in orders. If you want to sell 100 lot, go in with 20s and 30s, or go in with 10s. You know, if you want to go in with a 10 lot, go in with 2s and 4s. So just split the positions up. That way you also hide the orders as well, but you know, not necessarily something that you have to do. But some of the institutions do that. They do icebergs so they can hide the orders. Okay, so we continue here. So notice a 43 getting hit into, okay, but we can't take it out. So quite a bit of selling hit the bid there at 43, but we can't take it out. So now this example where 43 starts to hold, and then the 43 quarter starts to hold. So just watch it. So we've had a move down about 2 points, and you can see that purely from just looking at the dome. I've got a question here. Are you working offers or hitting bids when you're getting your size on? It depends on what position I'm trying to trade, right? But it also depends on the trade. So yeah, sometimes I lift offers, sometimes I put in a limit order on the bid. So when I'm you know, if you want to go in that market, you're going to get filled straight away. So if you want to lift the offer on a liquid market, you can go in and lift 1,000 lots if you like. But yeah, I'm usually trying to work in limit orders. So I'm usually working the bid on a long and working the offer on a short. So combination of both, Ben. Most of you guys know that, you know, if you trade, I mean, Ben, you trade. Most of you guys know that when you trade, you got to do a combination of both. You know, you don't always go in with it. I might want to go in with a limit order, but I'm not going to get hit on the bid. If it doesn't look like I want to get filled, I'm going to go in and lift the offer. If I want to get long, and I want to get long now, if it doesn't look like my bid's going to get filled, I'm going to go in and lift the offer. But ideally, I want to take the limit order. Okay, I want to get hit on the limit order because I want to gain that extra tick if I can, rather than give it up. Does that make sense, Ben? You know, it's only one tick. It doesn't matter so much on more volatile markets, but on a liquid market, of course, it makes sense. So yeah, you just go, yeah, you use a combination of both. There is no, you know, there's very rarely. I mean, to start off with, you might just go in that market and always work limit orders. But you know, when you develop some experience in trading, you're going to use a combination of both. You don't do one or the other. Now, I will probably say about 70 to 80% of my trades are limit orders. Probably more than that, actually. Most of my trades are going in with a limit order. Okay, but sometimes if the markets go in and I just want to get in, I will go in and hit the bid and lift the offer. Yeah. So, you know, it's an art form. You know, there's no right or wrong there. It's one tick difference when it comes to execution, hitting the bid, lifting the offer. But, you know, ideally, I think it's best to work in offers and bids. So you go in, put a limit order in the bid to get long, put an offer to get short. If you get that better price, better. You know, it's okay. But it's only one tick. So, you know, if you really want to get in, just go in and hit that market. But I often find that, you know, if you hit in that market, you know, like you said, you often find yourself go offside a little bit more often. Whereas if you go in with offers and bids, and you actually get that offer filled, quite often your offer fills, and it very, very rarely goes offside. You know, so you know every trade is different, of course. But James, just wondering, you got a question there. Just to confirm, what should we be focusing on looking at on the dome? Like I said, you're watching whether these bids, so the blue column in a downward move is holding or it's being taken out. Okay? And in an upwards move, you're asking yourself, okay, are those offers in the red column holding or are they being taken out? That's what you're looking at, James. So if you watch the video right now, that's pretty much what I'm trying to discuss right now, what you should be looking for. So, okay, so if you watch the video right now, we've just watched this all the way from 45s down to 43s, right? So we've been watching this all the way from 45s, taking out the bids all the way to 43. So that's exactly what you should be looking for. So if you're expecting a move down, this is exactly what you want to be seeing. You want to see the market pulling away from that 45 quarter where it's set up, and then start to pull away, and then start to hit the bids and continue to push lower and get through the bids that are sitting there as limit orders. Okay, so in the simplest form, you want to see when you're short the market taking out the bids that are below, and when you are long, you're waiting for the market, or you're looking to get long, you want to see the market holding the bids and actually start to take out some of the offers, right? Okay, so we'll play the video again. So now notice we just saw the 43 hold. Remember, there was about 2,000 or so on the bid, but most of that, you know, didn't get filled, but you can still see that it held. You can still see the level itself, the price itself, 43 held. And then all of a sudden you start to see some offers lifting at 43 quarter and 43 half. I mean, you can see that just from watching the dome. You don't need to look at price, you can see that. Now, you know, for argument's sake, let's just say 45 was an area where you was looking for a short, and 43 was an area where you're looking for a long. Now, if you're watching the dome and you see this happening, it's pretty useful. You can read that, right? Can everybody see that? And everybody can read it, right? You can see where the market went into the 43 and it held the support, and then it started to uptick, and then it's now starting to lift the offers. You can see how when we got into the 45 quarter, it held as resistance. We couldn't get through the 45 quarter, and then we started to hit into the 45s, hit into the 44.75s, and we started to push lower. Now what's happening here, we've already moved up. We're now trading 3 ticks higher. We're now testing the 43.75 offer, and we're trying to trade through those offers. Don't get too concerned with how much volume is actually sitting there. That's irrelevant. What you're concerned with is what's actually happening. Are we taking out those bids, or are those bids holding? Well, the bids below us at 43 quarter and 43 are holding, and we're starting to now lift the 43 half, 43.75. Does that make sense? Does anybody not understand that? Does anybody not understand that we can just see the 43 quarter holding right now in terms of price, irrelevant of volume, quantity, it doesn't matter. But what you can see is the market is holding the 43 quarter and is lifting 43 half, 43.75. You don't have to know exactly how much is being lifted. It's a fill. Okay, you can see the market is rejecting the 43 quarter, 43, and it's starting to lift. You can see earlier on the 45 quarter was being rejected, and we were starting to hit the bids. Right? Does everybody see that? Yeah? Good. Let's keep moving on. Again, it's not complicated. Some traders overcomplicate this. It's such a simple concept. You're only watching to see what's actually happening on the dome. Don't overcomplicate it. Don't, you know, start looking for, oh, when this much quantity shows, you know, this happens, or this much quantity starts selling, this happens. It's irrelevant of what quantity trades. You know, yes, you'll see some examples on the footprints where certain quantities do trade and the market tends to move, but it's not important. What's more important is what's happening. What's happening here is 45 quarters held as resistance, sellers started to hit the bids, and we hit bids sequentially lower until we held support at 43s. Now the 43 is holding, the bids keep holding, we can't take out the bids, and we're lifting the offers. So you're looking at the price column, but you are watching what's happening here on the inside bid. So you watch, for example, now watch the 44 quarter. There's 787 there. Okay, now that's got to be shifting up and down. That quantity is going to be changing, but you're not interested in the quantity that's there. You're interested in what happens there. You're interested in whether those offers disappear and we then start trading the offer at 44 half. So you are interested in what's happening to the numbers, but you're not interested in the specific number itself. Does that make sense? So you're not interested in the actual amount of volume that's sitting there. You're interested in what's happening to that volume. There's a difference. Does that make sense, guys? So you're not interested in how much volume is actually there, or the quantity, or the numbers that you see. You're interested in what's happening to that quantity. Okay, you're interested in what's happening to that volume. So, like I said, you're reading behavior. There's no such thing as more selling than buying, no such thing as more buying than selling. So if you're reading behavior, you're reading what's happening. What are the market participants actually doing? Well, the actual thing that you're watching for, and you're reading, and you're watching for in terms of behavior is, are they hitting into the bids and able to take them out at sequentially lower prices? Are they lifting the offers and able to take them out at sequentially higher prices? right? Does that make sense, James? And if you're watching the inside bid, so the current bid price is 44. We're looking at this right now. The current asking price is 44 quarter. So you're asking yourself in the moment, is the 44 quarter going to hold, or is the 44 going to hold? If you're going to take the 44 quarter out, all of that volume that you see there, where it's 787 or whatever it is on your end there, you can see that's going to disappear, and we're going to then be trading 44 quarter as the bid and then 44 half as the offer. Okay? That's what you're looking for. So now watch the 44 quarter. What's happening? We're lifting the 44 quarter. It's the volume is up and down, irrelevant of that. There's a lot of it spoofing, half of it's not real. Look, we take out the 44 quarter. What happens? We uptick. Then all of a sudden the offers at 44 half make us push back down again. Okay, but down watch that 44 quarter. Can we take it out again? So you're watching it as and when it's trading. Have we come back to 43s where we hold the support? No. So we're going to get these little ups and downs, little minor fluctuations. But the most important thing is we're trying to establish here, are we moving away from our support, 43s? And yes, we are. Are we continuing to lift the offers here? Okay, there we are, 44 quarters being lifted. Now we're trading the bid and offer at 44 quarter and 44 half. Right, you see what I mean? So we're moving higher at sequentially higher prices. So what you're watching as the market's moving higher and lower, as it's taking out the bids and offers. So the quantity is not important, it's the behavior. You're more interested in knowing, can the market hold the bids and keep lifting the offers? You're more interested in knowing, can the market hold the offers and keep hitting the bids and keep pushing lower? That's all you are interested in. Okay? That's all you need to know. Most of it's fill. When I'm sitting here trading the dome, I'm not sitting there looking at this with conscious effort. I'm not sitting there looking at how much volume is trading and not trading. I'm just looking at what's happening. What's the behavior of the market participants? If you can shift your mindset to trading what people are doing rather than trading numbers, you're on the right track. Does everybody get that? Okay? Don't try to trade specific numbers. When you're trading order flow, you're trying to trade what people are doing. You're trying to trade behavior. And the behavior that we've just seen here is 45 quarter offers are holding, and the buyers are not willing to keep buying through the 45 quarter. That was earlier on, and then we pushed through the 45s and the 44.75s, proving that the sellers were willing to hit the bids. So the behavior is showing that they are willing to hit the bids at lower prices and take this market lower. And then we continue to read that as and when it keeps happening until it gets to the point where the sellers can no longer keep hitting the bids and keep taking the price lower because they are no longer willing to. And then the buyers are actually willing to actually cut off those sellers by putting in some bids at 43s, 43 quarters. So they start to cut off the bids that are being cut off. So they start to cut off those sellers that are hitting into the bids. And then the buyers start lifting the offer and we start moving sequentially higher. Do I pay much attention to icebergs? They come in throughout the day, all of the time. I will watch the orders coming in, but if I'm more interested in what happens as a result of them rather than them actually trading. So I'm interested only to the extent of what happens next. Right, so I will see them. If anybody doesn't know what an iceberg is, if you keep watching this, you'll probably see at times these block sizes. And now sometimes the icebergs are traded in ones and twos. If you watch any time and sales in any market, okay, you'll see lots of these orders come in as ones and twos. But the larger orders, when they are iceberged in, they will generally show up as bigger chunks. Okay, so usually you can see it as an iceberg order taking place at the same price or around the same price range. If you put in an iceberg order on a trading platform, you basically say, okay, I want to short 100 contracts, and then you specify how you want to split it up. So you specify, okay, I want to go in and out with 10 lots, or 5 lots, or whatever it might be. And then you'll also specify within which price range you want to work in that order. So you might specify in your trading platform, okay, I want to work in an order within a 2-tick price range. So you specify that all in the trading platform, and then the trading platform actually automatically works in the order for you, but splits up the position. So Ben's just put a comment there. Too difficult now as you can vary the size, so you can stipulate lot size of up to 200 and will come in as different size lots. Yeah, I mean, you can vary the size, of course. I mean, I don't really, I just look for orders at the end of the day, whether it's an iceberg or whether it's somebody sitting there manually putting in those orders. I don't really need to know who it is and whether it's an iceberg or not. I'm interested in what's happening more than anything else. Now, of course, that's not the only way. Some traders will look at specifically, oh, this iceberg's come in and this might happen now, or you know, I see this size trade now, this might happen next. And that, if that works for you, fair enough. Not saying it doesn't work. It's just not the way that I look at order flow. We're talking about iceberg limit orders, but you can also split up market orders. So, I mean, I'm not talking about anything in particular. I'm interested in both happening. So now I'm not going to go into icebergs. It's not what this is about. So if anybody wants to, you know, talk about iceberg trades, etc., and orders, it's not something that I am planning to cover because I don't really pay too much interest to it so much. I'm more interested in what's actually happening. Okay, so yes, there are lots of different order types. I couldn't possibly figure out who's doing what and exactly what each trader in this world is doing. You could sit there and try to figure out what everybody is doing and try to figure out what order is what and what it might be, but it's only an idea. It doesn't necessarily mean, you know, that is factual or it's true. What you might assume is an iceberg order, it might not be. What you may assume is a big lot trader, it may not necessarily be. So, you know, we don't know. It's all, you know, it's all just an idea. So let's just bring us back to what we're looking at here, which is just reading some simple price action and how the orders are being traded through and orders are actually being held. So don't overcomplicate this. Don't start looking for specific sizes, specific orders. You know, when 100 lots, 200 lots flash up, 10 lots, 20 lots, etc., I'm a little bit more interested, yes. But at the same time, I've seen many of times when 200 lots, 300 lots, 500 lots have lifted into an offer and the market's actually gone lower. Because at the end of the day, remember that 200 lot, 500 lot buyer that's buying, you know, is lifting somebody's offer. So it's a zero-sum game. So it's irrelevant what size trades most of the time. Because even if a 100 lot buyer comes in and lifts the offer with a 100 lot, well, there's a 100 lot offer that just got filled as well. So it's a zero-sum game. So the numbers don't really matter so much, because for every buyer there's a seller, for every seller there's a buyer. So for every 10 lot buyer that we assume is a big lot buyer, there's a 10 lot seller. Does everybody understand that? So don't look too much into the numbers. Look at behavior. Look at the behavior. Okay, I know some traders will come in and they will say, okay, look, there's loads of 100 lots lifting. It's okay to look at that, but first understand, has the market just held support and is it starting to move sequentially higher? If you can see a combination of the price upticking and moving sequentially higher whilst the buyers are lifting the offers, that's a good sign of buying. Okay, now if you can see lots of sellers hitting the bids as we saw earlier on, and the orders keep flowing, hitting into the bids quite aggressively, big orders coming in, hitting the bids as the market's moving lower, that's more important. So if you are going to look at numbers and specific quantities, look at them in combination with what price is actually doing. Is the market actually upticking as the prices are starting, as the market participants are starting to lift the offers? Is the market downticking as the sellers are hitting the bids? Now, if lots of sellers are hitting into the bid, but the market price is not moving anywhere, meaning that, you know, we saw lots of sellers hit into the 43s there, 43 quarter, but they didn't take out the bid. Now, it's not important to us that lots of sellers hit into the bid. What's more important is that lots of sellers hit into the bid and the market then moved up. That's more important. So whether it's 2,000 sellers hitting into the bid there, or 100 sellers hitting into the bid, is irrelevant. What's more important is that lots of sellers hit into the bid and they still couldn't take out the bid, and those buyers' bids actually held. So even if there is a 100 lot, 200 lot seller there, 1,000 lots hitting into the bid, it's actually a good thing for the buy side if we can't take out that bid. And this is when we move on to the footprints. You'll see this a lot of the time. You'll see lots of volume hitting into the bid, but we won't be able to take out the bid. And this is when I often say in the trading room, we can't crack that bid. We're hitting into that bid, loads of volume trying to take it out, but we just can't get through it. That means there's absorption taking place. That means the sellers are hitting into the bids, but the buyers are absorbing those bids. So the buyers are absorbing those sellers. Okay? So that's when we say, this is what happened right here in this example. The buyer's bids absorbed the sellers that are hitting into the bid. When the sequence started, the sellers' offers at the 45 quarter and the 45 actually absorbed the buyers that were lifting the offers. Okay, but that's the behavior. It's the behavior of the market participants that we're reading here, not the specific numbers that are actually trading. We're more interested in the volume that's trading and what happens as a result of that volume that's trading. Okay, to price. This is why price and order flow has to go hand in hand. Okay, so we continue the sequence. We'll see that it keeps lifting. I think we end up getting back to around 45s here. So we're still seeing this lift. We're still lifting sequentially higher. So now all of these, lots selling into the bid. There's 14 lots, 10 lots, whatever. It's irrelevant because the market is actually trying to move higher. Now that might end up finally cutting off the market as it's moving higher. But whilst it's still upticking, as it keeps taking out the offers, this market is most likely to keep moving higher. So, again, it's the auction market theory principles. The auction market theory principles are buyers will keep lifting the offer until they're cut off. Sellers will keep hitting the bids until they're cut off. Okay? Sellers will keep hitting the bids until they are cut off. Buyers will keep lifting the offers at higher prices until they are cut off. Until they are cut off, that is the path of least resistance. Now, when we're looking for a trade, for an entry, we're actually trying to anticipate when the sellers are going to get cut off when we're trying to get long, and we're trying to anticipate when the buyers are going to get cut off when we're trying to get short. So in this situation, if we was coming into this 43 area, this was a key level actually on that day, key support area in this downtrend. Now that's the low there for that particular move down. Okay. Now if we had a key level at 43s, and we start to see what we've just experienced there happening at 43 quarter and 43s, we could start to get long purely just based upon that. Okay, purely based upon that, we could start getting long. Okay, now it might be a little bit aggressive for some. Okay, and it does take a lot of practice and experience to get good at timing your trades with just the dome. But it doesn't take a lot to be able to figure it out and read it. Okay, I mean there's a good example there. Anybody can sit there. I mean, I would just say if you're new to it, take a few days out and just watch what's happening in the dome. Watch what happens when you get to a key area for doing business. You will be able to see when we can't get through the offers anymore. You will be able to see when the sellers start hitting the bids and we start moving sequentially lower. You will be able to see when the buyers are hitting into the bids and they all of a sudden can't get through the next bid price. Then all of a sudden the buyers start lifting the offer. You will be able to see that from just the dome. Okay, without any fancy tools. Okay, most of you guys, any of you guys that are prop traders, you know this. Okay, this is how most prop traders trade. They get to the levels, they read the dome and get in purely based off that. Okay, now I took things a little bit further by also combining it with the market data footprints because it just gives me a historical picture and it makes it a lot easier for me to see and get even more of an edge. But again, it's not absolutely essential, and you can trade off levels just with this. So there is this misconception that people say, oh, the dome, you can't trade with it anymore. It's all misleading. Well, it is if you're looking at quantities. If you're starting to look at numbers and you're looking at quantities and trying to figure out what the market is trying to do based upon quantity alone, you're going to struggle with that anyway. Okay? But if you can look at it in the way that I'm just explaining here and ask yourself, what is the market actually trying to do? And you're just trying to read the market, and rather than trying to figure out what orders are going to move the market and whether those orders are going to move the market, you're just trying to figure out, okay, what is the market actually doing? It's getting into some support there. We don't need anything else. We can see it gets to 43 quarters here. We come back, you know, look what's happening at 43s. Watch it again. We hit the 43s, hit the 43s. Notice what happens. All those sellers come in, hit the bids. We can't take it out. Then what happens? We uptick. Then we start seeing the buyers lifting the offers. Okay, that in itself could be good enough to get long, if it's in a good place for doing business. Now, if you're a scalper, you could trade off that alone. Get in, stay with it until it loses momentum to the upside. That's actually all you need to do if you want to scalp. You don't need much else. Now, I've covered this in the scalping the DOM webinar before, where you just scalp off the order flow, scalp off the dome. Right? There we start lifting the offers. You can see the 43 just held. We couldn't take out those bids, and we start lifting the offers. Now, this is one example. Let's move on to the next video, which is actually a move that we had, I think it was on Thursday, when we continued to break higher. And then we continued to break higher, and then we actually held some resistance. So this is a move down, and you can see how, you know, potential bottom is being put in on the dome, even without seeing price action and anything else. You can see that the market moved from 45s, moved to 43s, couldn't get through the 43s, started to push up, and then by the end of this, we ended up pushing back to, you know, 44 halves, 45s. Okay. Now let's move to the next one. Now, if you guys are watching this in Instant Presenter, it might be a little bit delayed, but let's just pause this again. So, what I want you guys to watch now, this is a new high that's been put in this week on the E-mini S&P. It was actually on Thursday. And I think it was Thursday. Yeah, Thursday. And the market basically just put in new highs, and you can see the volume distribution starting to show some acceptance up here. Okay, so this is how you can use the micro profile. Good stuff, Ben. Glad you find it useful. Like I said, it's not really that sophisticated or complicated, and that's most of the good things aren't. Most of the good things are very simple and easy to read and easy to see and easy to apply, and that's what, you know, you want in your trading. You just want to see that, you know, it's a very simple concept. You're in a good area for doing business. You know, you can watch the dome, and that's what a lot of the time I would do. I'll sit there, I'll watch the dome. Every now and again I'll watch what's happening, you know, on my footprints as well, and the footprints will confirm it, and I'll use the combination of what I see on the dome as well as the footprints. Now, I don't use the dome itself, but you can use the dome itself, okay? And sometimes when I'm a little bit more aggressive, I'm anticipating something's going to happen, I'd go in with just what I see with price action and rejection, and, you know, and what I see happening here as we're moving up and down the ladder. Okay, it also helps on your dome to have a static dome. Now, one of the reasons why I love Trading Technologies Xtrader is because it has this static dome that you can see as price trades up and down the ladder. Now, it's a patented technology for Trading Technologies, but a lot of trading platforms have mimicked it in a slightly different way. But you know, you can see it. So you might want to take the auto center off on your dome if you're planning to read and get a feel for the market based upon the trading platform and the dome. So yeah, I mean, there's nothing wrong with that, right, Ben? You know, high Kanashi bars, put a stop above the highs. You know, put a going with a high Kanashi bar, and sometimes with the more faster markets, the higher momentum markets like the DAX, the Nasdaq or the Dow, the Bunds when it's really moving. Sometimes it's a good idea to wait for that high Kanashi bar confirmation and then go in with that, and you know, yeah, just go with the momentum. There's nothing wrong with going with the momentum and using closing bars for entry. Like I said, as long as it's still a good place in reference to the structure where you're doing business, that's fine. So this is more of an, you know, may just be used as a heads up for some. May not necessarily get them into the trade, but may just be observed as a heads up, and maybe a way to observe what the market is doing at an area for doing business, but not necessarily get into the trade. Okay, so this is an example. I think we end up trading, it's only about a 1.5 point move up, but I want you guys to notice here we hit into sort of 67, 66, 75, and then, you know, watch what's happening on the bids, and those bids, notice, can we take them out, can we get through them, and then notice when the market's upticking, do we start lifting the offers here? Okay, and that's what will happen. So don't be concerned with the quantity here, and this is why some traders will say the dome isn't unreadable anymore, because they'll watch the quantities there. The quantities are not important. Most of this is unreal. A lot of this is just changing. It's flipping up and down. You see 2,000 here 1 second, and then the next second there's nothing there. It's a lot of it's not even real. A lot of this is just electronic trade, computers just putting in orders away from the market, making it look like something's going on and nothing's really going on. Okay, so most of it's not real. Actually, the time when we had the flash crash, I recognized that all of these bids and offers completely disappeared, or almost. We normally see, as you can see here on the E-mini S&P, we've got between 1,000 to 2,000 on each bid and offer price. Okay, at each price. Okay, but what happened before we had the flash crash, and a few days before that, we saw all of this just dropped. It was about 300, 400 on the bid and the offer. And actually, and I said that at that point in time. I said this last time I saw this was 2008, and it's like all the computers have been unplugged, and the market just dropped. It was dropping through those bids like nothing. Okay, because there was nothing there to hold it up. There was no volume there. There was no electronic trade. The high frequency systems was not there. It's like someone switched them off. I don't know. But something happened. Okay, but we saw this in the thing is in really volatile phases, like in August, September on the E-mini S&P. Most of this quantity here on the bid and the offer dried up, and the reason why the market actually becomes volatile is because it can move through those prices more quickly. Okay, so the thicker it is, the slower it usually moves through it. Okay, so think of each one of these prices and the quantity you see there as a queue. Okay, it's like being at a supermarket. If there's 1,528 in the queue, it's going to take you longer to get served. Okay, now if you're on the bid at 67th, there's 199 in the queue. You're going to get served quicker. So one of the things you'll see when I show you the trade sequence after the trade management section is that you'll see when I've got some orders in, you can actually see in Trading Technologies Xtrader how far you are in the queue from getting filled, which is a unique feature of Trading Technologies Xtrader, and that's why I like it. It's extremely useful when you plan to go in with limit orders most of the time, which is what I like to do. And you can see how far you are from getting filled. And I will often watch that, and if it looks like I'm not going to get filled, I'll go in that market. If I can see I'm good 2,000 contracts behind and it's hitting into that bid, and I'm looking to get long on the bid, and it doesn't look like I'm going to get filled, and it doesn't look like it's chewing away on that bid, I might as well just lift the offer. So I'll show you guys that a little bit later. So you'll see that this column here on the left of the blue column, that's where that usually shows up. Okay, but it's not there right now. It's called the EPIQ column. Now this trading platform that I use, I will say that it's not a cheap platform. I have to pay for this. I pay usually, it goes up and down because it's in dollars, but it's between 700 to 800 pounds a month just for 2 exchanges, the Eurex and the CME. Now, if you want more exchanges, it costs more. One exchange will usually cost you about £500, £600 a month. Now, a lot of retail trading platforms will be free, and they will be able to do most of the same stuff. But like I said, this is the industry standard, and most people that use this have to pay for it. Okay. Now, even if you do trade the firm's capital as a prop trader, it will go out of your desk fees. Okay, so you do pay for the software that you use, and I pay for this from my own capital. So do understand that this software is it's not the cheapest, not probably the best option for most people to go for. If you go for it as a retail trader, it is quite expensive. Now there is a broker, Velocity Futures, which I'm not too familiar with, but I've heard that they offer it for free, but nothing's for free, as we all know. What they do is actually charge you more per trade, so you end up paying for the software through commissions. Okay, so just wanted to cover that. So this is the video here. Just watch what happens. I'm not going to discuss it too much. I just want you to understand what I've just discussed in the first video, and now watch what happens in this one. Just want you guys to spend some time getting used to reading it. So from understanding, okay, you're watching whether this market can take out the bids or the offers. Then once it starts to take out the bids or the offers, does it start to move in that direction? Does it keep moving in that direction? And you can see that by watching how the orders are getting taken out. So you'll see these offers in this sequence start to get taken out, and you'll see the actual orders that are taking those offers out coming in on the time and sales, okay, on the right hand side. So watch it. It's a little bit slower, so you can see this. So look, we're hitting into the 67s. What's happening? 67s, not a lot of volume there. It's irrelevant. What's more important is that we can't take it out at the moment. Then we start lifting the 67 quarter. Now somebody that's looking at volume is going to say, okay, there's lots of offers at 67 quarter. More than likely is going to hold the 67 quarter, and it might do for a couple of ticks. Okay, but it doesn't. Look, what happened? Did you guys just see that? Most of that volume didn't even get traded. Because if I take this back, watch what happened at 67 quarter. Most of it didn't get traded. Some of it did trade. Some of it was lifted by buyers that lifted the offer. But most of it just disappeared. It wasn't real selling. It wasn't real sellers that are willing to sell at that offer. Right? You'll see this all the time. Okay? So watch that again. Watch the 67 quarter. There's about 1,500 on the offer. Then some of it will trade, as you see on the time of sales. Then most of it just gets out of the way. That's a sign the market wants to move higher. Now it'd be the opposite if the market wants to move lower. If the bids get out of the way, then all of a sudden the market usually cracks through those bids and moves quickly. Okay, so see that 67 quarter got taken out. Then watch the 67 half. We trade some of it, but most of that volume doesn't even trade. Yeah, there will be some times where we will take out all of those offers or those bids, but most of those orders that are on the bid and the offer that you see on your dome are not even real. They don't even want to trade. Most of them just get out of the way. See that 67.75 there? Some offers came in there. We pushed down. We took out some of the bids, but look, we come straight back up 67.75. The fact that it comes straight back up to that 67.75 is an important reason to watch that. And look, the offers are just disappearing now. And actually, if you look at the time of sales, most of that's not even being traded. Most of that is not even being traded. It's just getting out of the way. So there's either sellers putting offers in, trying to spoof the market, or probably a computer sitting there somewhere putting some offers in and then putting them in and then putting them again. And the exchanges have a lot of this set up just to provide liquidity, to make it look like there's orders there, when actually some of it is there to provide liquidity so that people can actually trade these markets. But only part of it is there, put there by the exchanges themselves, or people that work on behalf of the exchanges. There's a lot of it's there to just provide liquidity, so people can buy the offer if they want to. They can hit into the bid if they want to. It's the liquidity. That's the liquidity. So there we are, taking 67.75 out. Okay, then we get a 68. So you can see how we moved from 66.75, lifting the offers up to 68. So we moved from 67. So it's about a point move there. 1 point move higher. Okay. So far. Okay. Then we start taking out the offers at 68. So then we test the 68 quarter, test 68 quarter. We're lifting. Some offers are actually coming in. So rather than getting out of the way at the moment, they're still coming in. Okay, and we're actually lifting those offers. Okay, we're lifting offers, but the quantity is not really going down. Quite a bit of volume lifting there at 68 quarter. There we are, and then all of a sudden 68 quarter starts to drop to almost nothing left there at 68 quarter. And then we get through it. Okay, then we go to 6850, and look, there's quite a bit sitting there, 2,500. Okay, now the question is, it's not important to know there's 2,600 there. What you don't want to do is sit there and say, oh, 2,600 on the offer, that means the market's going to move lower because there's so many offers. No, that's a wrong way to think about it. What you've got to ask yourself is, okay, there's 2,600 here. You've got to be asking yourself, is it real? Are they going to hold and cut off this buying? Or are they going to start getting out of the way and more buyers are going to keep lifting the offer? That's what you're interested in. Behavior, not numbers. Okay, what happens? 68 half, it holds for the moment, down ticks. Now you watch a 68 quarter. Does it start to hold and move away from 68 halves? What happens? I'm not quite sure what happens in this situation, but let's just read it as it's happening. Looks like we're holding 68 half at the moment. We're hitting into 68s, but we're not taking out the 68. We're trading the 68 and the 68 quarter. Looks like we're still holding there. Let's speed this up a little bit. Let's push along a bit. Looks like the 68 is holding, right? So what happens, the 68 starts to hold there for a short period of time, and I think we don't end up getting through it. Yeah, in the end we don't end up getting through it. So you can see the 68, what is it, 68 half actually held. Then we didn't revisit the 68 half. And I often say, look, you know, my terminology and the way that I'm talking in the room is, okay, look, got a level of resistance here. Let's just say that we had some resistance at 68 halves. Look, I'll say buyers are lifting the offers. I'm trying to anticipate when these buyers are going to get cut off. All right, there we are. 68 half just traded. We can't get back there. We can't offer the 68 half anymore. We're hitting into the big 68 quarter. Now we're bid 68. We're offering 68 quarters. We can't get back to the 68 half. It's just been rejected. Okay, it's been rejected at 68 half. So it'd be interesting to see if we can hold that rejection. So it's rejection, but from a micro level. Okay, and then what I do is, after that rejection has occurred, then I start a short. Now in this situation, I'll be looking at, okay, 68 half is held. I'll be looking for a short around 68 quarter, 68. But then I'll move to the footprints, which I'm going to cover in a while, and start to confirm this, and start to confirm whether I actually did see rejection. Okay, now the footprints confirms a lot of this. Okay, we're going to read the same information on the footprints, but it's going to confirm it. Okay, so that's pretty much that sequence. So, any questions about the depth of market there? Just wanted to give you an idea of how I would read it and what would be my thought process when I'm looking at that. It's very simple, really, but like I said, don't overcomplicate it. It's just one tool, you know. You could use just the depth of market to trade and execute, but there are other tools that I use in a combination with that. Good stuff. Right, now I covered the time and sales. This is basically the same thing. It's the time and sales within market delta. Now time and sales is pretty much on most platforms, charting platforms as well as trading platforms. So I have a time and sales window, as you can see, right next to my dome, because I can easily compare it. Then I also have a time and sales on my charting PC, which I'll share in the trading room. Okay. Okay, so we can either continue to stay with this format, which I'm sharing right now. I can move back to the previous format until we got the next video, which is probably the best thing to do. So if you guys want to just move back to Instant Presenter now, because we have got a video, but it's a little bit later on. Yeah, you can leave the other one open, Bed, and actually I'll you can leave the other one open, but yeah, so don't close it. So you can leave it on. If you've got out, you can always log back in again when I share the next video, which is a little bit later on. That probably not going to be until later this afternoon, evening. Okay. So just give me a minute here, guys. Okay, so time and sales is what I call post-trade supply and demand. So what I showed you on the dome, the depth of market on the price ladder, in the blue column was the bids, the resting bids, what I call pre-trade demand, because it hasn't traded yet. And then we have on the offer, the red column, we had the pre-trade supply, because it hasn't traded yet. So those are limit orders waiting there ready to trade. Okay, only some of them are real. A lot of them are not even real orders. Okay, so what you got to remember is that a lot of that is manipulated. It's not real. Okay, so don't try to trade off the actual figures there and the numbers. Now you used to be able to do that somewhat, you know, 5-6 years ago, quite effectively. and a lot of traders made a lot of money doing that. But you know, when they kept doing that, you know, I know a lot of traders have lost a lot of money trying to trade the way that they've traded with that information before. But you know, you got to adapt. You know, that's what I did. I adapted and I started to use other tools to help me trade with the order flow, but you know, more effectively. So you know, I don't wait around. I will move forward and grow and use what's next, what's best. You don't necessarily need a lot, but you know, footprints I've been using for a long time now, since around 2005 now, and you know, it's really helped me out. Now, time and sales is post-trade supply and demand. Time and sales windows are very much the same in any platform. You usually have a timestamp, the date, and the time that it traded, and then you actually have the price that we traded, and then the volume that traded at that price. Now, different data feeds will show the volume slightly different. I use DTN IQ feed for my data in Market Delta, and I use Trading Technologies Xtrader data feed directly from my prop firm, and that is pretty much the same as DTN IQ feed, but some orders may show up as one big chunk sometimes on Trading Technologies, but most of the time it's the same. Okay, so different data feed providers can sometimes display this data differently. Sometimes they bundle the data, and you won't necessarily have all of the orders as individual orders come through, but most data feeds now do show you each and every single order separated. Yeah, IB is absolutely, Interactive Brokers is not that great. It's they chunk up the orders to and I suppose that reduces bandwidth uses and the amount of data coming through, so they just throw orders that all traded at one price, you know, as one chunk of trade, when it necessarily could have been lots of separate trades. So DTN is very good. DTN IQ feed is very good. Oh right, interesting. Zenfire puts traders on the wrong side at times, which is moving through levels quickly. Yeah, I've heard Zenfire is not that great. So you know, do have a great data feed. Now I can personally vouch for DTN IQ feed data. It's great for order flow. It's probably the best for charting, for using the footprints, as well as time and sales. And I think, yep, there we are. Peter agrees. Peter's actually done a lot of work with time and sales and order flow stuff, and actually has developed his own tools which read the time and sales data. And you know, I'm glad that we both agree. So I think most people. Have I seen the DOM of Market Delta, the depth of market? That you mean the trading platform that Market Delta offer, Market Delta Trader? Yes, actually I tested it for them before they brought it out. It's pretty good. It's nice because you can see the footprints. It's actually really good for the way that I trade and the way that I like to use the footprints for execution, because you can see the DOM, depth of market, side by side with the actual footprints. The only downside is, for me, they don't support, as current moment in time, they can't support the setup that I have for a prop firm, you know, and support, you know, the TT's data feed. So, you know, it's a great platform, and I would use it actually as an execution platform if they supported my setup. But they do support it, but it's only through a number of brokerages at the moment. I think OpenECRY and somebody else. I think you can actually, they've now set it up for CQG, which might be an option for me because my prop firm does offer CQG, so I might be able to use it with that. But I think that's still in development. I'm not sure if that's been released. So yeah, it is a good option. The only thing I didn't like about it is that it does trade with one column. So there's not a bid and ask column. It's just one column. So you guys can download a trial for it. And I did mention that to Market Delta and Trevor, and I did mention that, you know, I would like to see two columns, because I'm used to trading with two columns. I like to have the bid and the ask side. And I personally found through testing it that sometimes you might end up, because if the market is moving very quickly, because there's just one column to actually execute off, you have to click on the bid price, which is below the current market, and the offer price above the current market, to put in a bid and the ask. So now if you're like me trading off the ladder, it can sometimes cause you to put a short in when you want to get long, which is a little bit, that was some of the feedback that I gave. So that was the only really downside to it, but otherwise it's very, very good, and I love the concept. I just like to have two columns, the bid and the ask, which I'm used to, and pretty what most traders are used to actually execute at. So yeah, you can download a demo for it if anybody hasn't seen it. It's good. I think they will be actually incorporating that into the software somehow, the charting software, but I'm not quite sure exactly when that's going to happen, but I know the developments are in place. So yeah, it's good. But I like Trading Technologies Xtrader. I've used it for a long time. I love it. It's what I'm used to. Now, I did use Infinity Futures Transact platform, the Infinity AT platform, and that's pretty good as a retail trading platform. And NinjaTrader is pretty good as well as retail trading platforms. I actually used the Infinity AT platform in the trading room when I was trading crude oil. It was took a little bit of getting used to, but you know, it's a little bit different, but it's not that different. Once you've traded one trading platform, you can trade with pretty much anyone. It does sometimes take a little bit of getting used to where things are, but most of them are very much the same. Okay, so time of sales data. We are looking at post-trade supply and demand. So it's the actual volume that traded. So this is trade that's actually gone into the market. It's actually there, it's real. Okay, this is what I'm more interested in, because the resting bids and offers, the quantities there are often false, okay, and often very misleading. So I will watch out what's there, but I'm not too interested in the quantities there on the bids and the offers. I'm more interested in the quantities that actually trade. Okay, and the actual traded volume is, you know, viewable on the time of sales. And this is what often is referred to as tape reading. Reading the tape is reading the time of sales. It's reading the orders as they trade at each price. Now, on my time of sales window in my charts, which you'll see in the trading room, is you'll see that every time we trade on the bid, it's highlighted in red, and every time we trade on the offer, it's highlighted in green. So the way that I look at it is red is aggressive selling, sellers hitting into the bids, but green is buyers lifting the offer. But it doesn't necessarily mean when you see lots of green that the market's going to move up and lots of red the market's going to move down. It doesn't always work that way, because sellers could be hitting into the bids, but the market's in a place where we accept the buyer's bids to absorb those bids. So it's more important to know where it's happening first before you start just reading order flow. So it's important to understand context. You never apply order flow itself without outside of context. You always have to have an understanding of context first. Okay, not saying that you can't trade order flow itself. You can, but it's often difficult and can be misleading. Now, the footprint windows, or footprint charts, should I say, are a little bit different. It uses the same data that we see on the time and sales window, but as that volume trades at each price, the footprint is able to organize that data in an easily readable manner, where you can actually see how much volume actually accumulated over a specific period of time or a specific price range at that particular price on the bid and on the offer. Now, this is my typical view of the footprints. We have the bid column on the left and the ask column on the right. So let's focus on this specific footprint right here. What do we see here? Well, we can see in this particular bar, when we traded lower, only 48 hit the bid. That means sellers couldn't get through that price. Okay, that's shown by the fact that low volume was only able to trade into that level. Okay, now what we also see is sellers were hitting into the bids right here, 5,536 contracts hit the bid, 1,493 hit the bid. But remember, never forget that there are buyers' bids getting filled when those sellers are hitting the bid. So we're only interested with that being setting until the point where it gets cut off. So what I'm normally looking for, okay, where has that got cut off? And that's normally shown by on the footprint when you get low volume prints. When you see low volume prints, that means lack of volume traded there. That's a sign of rejection. So a lot of the time in the lows of a bar, you'll see low volume like this. Only 20 traded there, only 48 traded there. Here only 14 traded. Okay, you can see this bar, this green bar here, right here. This actually shows the open and the close of that bar. It's like a candlestick basically. So the low was here, the high was up there. And that green body there, you can just make it out there. That's the open and the close of that bar. So you can actually see here, this bar opened here and closed all the way up here. So here's the open and here's the close. Can you guys see what happened at the low of that bar? Only 20 traded. Now, if you think of that as behavior, what does that mean? It means, well, the sellers were hitting into the bids, but they couldn't get through that bid, and the buyers' bids absorbed those sellers. Okay, and of course this is happening in real time, so you have to read it when it's happening in real time. Now, what happened as a result of that afterwards is that buyers started to lift the offers, and it became very, very clear here, where we started to see a lot more buying lifting the offer. 2,414 lift the offer, only 525 hit the bid. 1,443 lift the offer. Now, I'm not concerned with the exact numbers here. I'm just more interested in, is more buying lifting the offer than the volume hitting the bid? So sellers will still be hitting the bids as the market's moving up, and the buyers will still be lifting the offers. But if I'm long here and I'm getting long here that after this rejection has occurred, I want to see this follow through and the continuation of buyers lifting the offer to stay with the trade. Okay, you can see when it starts to edge off here, when we start to see the volume lifting the offer starts to dry up a little bit. Now the next bar still traded there and lifted some more offers. Okay, so remember the volume on the right hand side is the ask volume on the ask. So it's got to be considered as buying volume, or volume that's traded on the offer. Sorry, not considered as buying volume, it's volume that's traded on the offer, but if it's lifting the offer as we're moving higher, that's considered as volume that is lifting the offers at sequentially higher prices. So more often than not, when you see more buyers lifting the offer at sequentially higher prices and the sellers are hitting the bids with less quantity, doesn't mean the sellers won't hit the bids, they will, but they will hit the bids with less quantity. Okay, we will see the market move higher. When we start to see that the buying starts to get cut off, it's only a heads up, like here. So I'll use this as a heads up. So let's say I've got a key level up here. I'd say to myself, okay, it looks like the buyers are starting to struggle to lift the offers here, but then again, the next bar still lifts. Okay, then I'll keep watching it, still keeps painting in this area. Then we see only 188 lift the offer. Then I say, okay, well, 1408 lift the offer there, and now only 188 lift the offer. So the first sign of rejection on higher prices is when the buyers start to get cut off. So a move starts lower firstly when buyers get cut off, and a move starts when it starts to push higher firstly when sellers get cut off. So the first thing you should be looking for on the footprints when you're looking for a reason to start stalking for an entry, remember this is not a reason to pull the trigger, this is all leading up to the point when you pull the trigger. You have to first read, okay, the market's pushing up. Most of the time you're going to see the market pushing up into your area of resistance, so you're waiting for signs that the buyers are going to get cut off. So let's say we're sitting here watching these buyers lifting the offers here, and then we're waiting for signs that they might be getting cut off. The heads up is when they start to get cut off. Okay, there it is, 188 lift the offer, but it's pretty much in this range. Okay, so we start to get cut off there, and then we start to see some sellers hitting the bids, as we can see in this bar. Okay, next bar starts to trade, we come back up again, can't lift the offer at this price. So this is similar to what we might see on the dome occurring. We say, okay, let's just say that was 45 quarter. Okay, because that was the level we saw earlier on the dome. Now we get a 45 quarter, we get back to 45s. Okay, not only can't we lift the 45 quarter, we can't even trade there. Okay, we can't even trade, we can't even offer the 45 quarter. Okay, then we offer a tick below that, and we trade the bid at 44.75. What happens? the market only lists 46 now, at a lower price from where the 45 quarters was traded. So not only have we seen buyers get cut off, but we've seen them get cut off at the next downtick, on the next price that was offered. Okay, and then we start to see buyers hitting the sellers hitting the bids. Okay, now this bar, you can't see exactly what's happening in the bar as and when it's building in real time, but that's what you have to develop a feel for. But this is what you need to look for, information. So that's the sign that the buyers are getting cut off. That's your first heads up. That's when, now if I'm a little bit more aggressive, I'll start selling into that. Okay, but I need to see clear signs that we can't push higher and the buyers are definitely drying up. So I'm waiting for the buyers that are lifting the offers to start drying up. Okay, I want to see that volume drying up when it's lifting the offers. And as that volume starts to dry up as it's lifting the offers, then I can start saying to myself, okay, now I'm waiting for sellers to start hitting the bids. You can see the sellers really become evident hitting the bids here at the lower prices, which is more so the confirmation and the follow through. So if you're a little bit more conservative, you'll get short in this area. If you're a little bit more aggressive, you'll start actually selling into the buying as it's getting cut off. Okay, so that's a basic example of the footprints. And what I'm going to spend the rest of the time doing is going through more footprint examples on the actual charts. And I'll discuss some various ways to set the footprints up, and you can ask me questions and pick my brains about situations on the footprints. Now the best place to see it happening live is in the trading room. Most of you guys are room members. That's the next best place to see it. But otherwise you're going to have to apply what I'm going to be teaching you here on the footprints in real time and keep observing it, keep watching for it, keep applying those concepts, keep reading those concepts, and get in tune with it. Okay. All right. On that note, let's have our break.